Hey guys, Ken Calcutt here with Cornerstone Financial Management. Just wanted to give you an update. We're halfway through 2023 now. Here it is, early July. Quite a surprising market so far this year for most of us. We've had a pretty positive stock market, especially the last 2 or 3 months. We went into this year thinking this was going to be a rough year, probably going to have a recession, earnings are going to come down, expecting stock market might continue to drop. It hasn't been the case. We've had quite the rally, which is encouraging, but there are some concerns here with this. The rally has pretty much been fueled by AI. If you watch the news, a lot of talk about artificial intelligence that kind of started back in March. And there's a lot of benefits to AI that we think might be coming in the next several years. There's a handful of technology companies that have really benefited from this dialogue we've been seeing this year with AI. There's about 7 to 10 technology companies that have had tremendous growth this year we've seen in their stock price, and that is primarily what's responsible for us seeing the stock market overall grow this year. If you took out those 7 to 10 stocks from the stock market, we've had a relatively modest growth in the market this year. So we have to be mindful that a lot of the growth we're seeing this year so far has been attributed to just a small number of tech companies, which is not a great thing. We want to see more of the market, more stocks participate in this growth. We did start to see that in June. We started to see a larger number of stocks growing in June and a more balanced approach to this rally, which is good. So from a technical standpoint, what we're seeing is it looks like it could be the beginning of a new bull market. The technicals are lining up well and kind of breaking out this year, as they say. And so things are improving on the technical side, but we still have the fundamental side of the market that is concerning. And so we've got conflicting info. The Fed is still not done raising interest rates. We think they're going to be done soon. My guess is they're going to have maybe 2 more rate hikes, probably stop around 5.5%. But we don't know for sure. They're still raising rates. That is still kind of a recessionary pressure on the economy. And anytime we go through these rate hike cycles, we normally expect it to end with a recession of some kind. And so the bond market is clearly signaling we should have a recession. History tells us that rate hike cycles typically end with a recession, but the stock market is clearly not behaving as if there's a recession coming. And so we have very conflicting information right now. We just simply don't know if a recession is going to come or not, which is exactly why we stay diversified with the portfolios, we stay balanced. We don't bet heavily one way or the other that we're going to have a recession or we're not. We stay balanced, we stay disciplined, we don't chase these returns from these technology companies, and we don't completely bail out of the market if we feel convinced that we're going to have a recession. So right now our approach is cautiously optimistic. We're staying balanced, we're getting good growth from these tech companies in this AI conversation, but we're also in a lot of the more balanced investments that are dividend stocks, maybe bonds, depending on your risk tolerance. So far, good year. Surprising growth in the first half. I think that will continue in the second half. There's no way to know for sure, but I'm optimistic that we'll have a good second half. But we will continue to stay balanced and diversified with the portfolios and make adjustments as the opportunities present themselves. We'll keep you posted. If you have questions, feel free to reach out with email or phone call anytime. Thank you.